Excellent. So thank you very much for joining our panel. I think we have a very interesting topic, or like talking about a really nice to have problem, which is about onboarding clients and services into the crypto marketing services. So before we start, I thought it was a good idea just maybe very quickly go around, maybe Mota, Caselin, if you want to start, just like introducing yourself, maybe your company, keep it short and crisp, and then we jump right in.
Hi, everyone. Happy to be here and see a lot of our customers, friends, business partners. My name is Kalin Metodiev. I'm a co-founder and managing partner at Nexo, the largest retail-oriented crypto lending platform, which has multiple integrated services such as borrowing, lending solutions, trading for retail and institutional clients, and as you may have seen, the biggest news over the last couple of days, we also made our first investment in a federally chartered U.S. bank, which is one of the many steps that we will take in this direction to integrate traditional banking services on our platform. And then the next step will be wealth and asset management all under one platform.
All right.
Hey guys, my name is Anand Gomes. I'm the co-founder and CEO of Paradigm. Paradigm is an institutional liquidity network focused on derivatives. You can think of it as an over-the-counter marketplace where institutions buy and sell crypto derivatives. At this point, I think volume-wise, we're about 35% of the global options market. We have about 2,500 institutions on the platform. I think at this point we're both the largest as well as the fastest growing institutional network in crypto.
Hello everybody, Ben Caselin, VP Global Marketing and Head of Research at AX. AX actually went live in 2019 and we had a very strong institutional focus. But actually, we evolved beyond it to a different place, and I think it'd be very interesting to share about that. Main products are like savings, futures trading, spot trading. Actually, in July, we came second just after Binance in spot volume globally. So, there's been a lot of changes over the past year, especially around emerging markets. So I will be very interested in this conversation. Thank you.
Excellent. And maybe this is a good start. Obviously, we'll, when you talk about onboarding, you have various types of clients. And Anand, what you said around institutional, maybe you can start there. What you see are the trends, particularly when it comes to institutional players coming into the crypto market, the trends and onboarding. Then Ben, maybe given your experience, if you want to maybe then respond to how that, what your opinion is on that.
Yeah, sure. Over the last 6-8 months or so, we've seen a big push from institutions, both in terms of the allocation, the amount of money they're allocating towards crypto, as well as sort of the tools and compliance processes and et cetera, the demand from platforms such as ourselves. So we've had to add almost a full-time sort of ops team now to sort of help these folks jump on, because they have a bunch of DD processes that they go through before. But also just in terms of the tools they're asking from us in terms of the features and from a liquidity perspective and an execution perspective. So in fact, over the last 6 months, as you probably know, people are calling it the crypto winter, and volumes are down for the most part, but our volumes are actually up. So we've almost doubled market share in the last 6 months or so, mainly because on a relative basis, the institutional segment of the market is growing way faster than the retail folks.
Okay, maybe Ben, just very quickly on this, institutional versus retail. Do you see big differences between how these two segments look at the onboarding process?
I mean, it's quite interesting, right? That we make this separation between the institutions and retail. So, when AX was founded, it was in 2018. This was right after the all-time high, right? Bitcoin went to 20K and then started to come down. And I think everybody kind of understood, okay, this is not going away. We need to build this out and build it properly. Mm-hmm. And so, okay, we founded the exchange and we implemented, we were very, very fortunate to have a collaboration with the London Stock Exchange Group. And basically, we're the first crypto exchange to deploy the same matching engine that runs on the London Stock Exchange and the Mongolian exchange. Okay. And so, this was our play. And we knew that if we build out the right infrastructure and set the right settings and we're able to kind of operate on par with traditional exchanges, then surely we must attract institutional capital. It didn't happen. Why? Because the institutions were looking for retail to trade with us, and there was kind of this idea, like they need the liquidity of retail. And I don't know, this really changed our strategy. Like, first of all, we had to focus on retail big time. But as we start to focus on retail, and you get into the story of course, we're not just setting them up for the institutions to kind of profit on. So the story becomes different. And you realize that actually, instead of price and trading, we should actually talk around kind of the use cases, especially for kind of the majority of the world, right? In a place like Singapore, most of us, have bank accounts. We can rely on a robust system. The majority of the world, 6.8 billion people, don't. And so in the conversation, as we started to engage retail, you realize that perhaps sometimes the institutions, even though they're coming in en masse, may not just be aligned yet with the kind of goals of the space. And that is, I think, a little bit of a problem. Because when we see this instability with Celsius and Luna, a lot of people will come in and say, okay, we need to put TradFi principles on top of this. I think we should question that and think about perhaps some new principles that we can build new financial systems on.
Kalin, I think maybe to bring you in, and we had a chance actually before and even yesterday talk a lot about your business, and I think these were similar themes you raised in terms of the risk management and best practices in that market, and also the institutional versus retail trading. So maybe if you want to give us your perspective on those topics.
Yes, absolutely, Sven. We had a very good conversation around these themes, and this is that no matter whether you're servicing your retail customers or the institutions that are onboarding with us, inevitably all of them want the same thing. They want, obviously the best UI that you can offer to them, the best execution, and last but not least, risk management. When it comes to the institutions, it's a much easier conversation because the institutions by default, have already their policies, procedures, systems. They know the questions that they need to be asking. And many of them, engaged in a formal due diligence process where all of these aspects are covered. I really wish, that many of the retail customers around the world were doing their homework as well, before they blindly entrusted, their assets to, multiple platforms, that only did an excellent job at advertising capabilities, which unfortunately weren't there, or advertised business models that didn't really exist on a sustainable model. So, for us, it's a completely different approach. Whether it's with our retail customers, whether it's with institutions. First of all, we always build our relationships on full transparency. One of the things, that many of you have noticed is that we were the first institution that introduced real-time audit of our balances on our platform. You can go to our website and you can see in real time that our assets exceed our liabilities in real time at all times. And perhaps, many customers, also wish to see that on the investment banking's, platforms back in 2008, when everybody was wondering, are these guys solvent or not? There is a real-time verification for you. We have also full transparency when it comes to our financials, and we're readily available to share it with our institutional counterparties. As far as execution is concerned, we try to be as agnostic as possible. So we're not an individual exchange. We don't direct and essentially navigate trading, just on one platform. We take the best execution where we can get it in the market by, connecting to 20 plus exchanges and liquidity providers. If you are an institution, if you're a retail customer and you come and look at these benefits, I think it's very easy. We make it easy for any, client segment, to come and onboard easy with us and feel comfortable that we're there to protect their interest.
Thank you.
I have a slightly maybe different perspective than Ben. I don't think we really need a rethink of principles because risk management is risk management, right? I mean, and people have been managing P&Ls and TradFi for a long time. But I do think, we have a chance here, to your point about reshaping or rebuilding a financial system. I think what we can do is use the same principles, but have technology-first solutions, and specifically in Web3, have solutions that preserve the principles of, Web3, right? And remaining non-custodial, where you can try to be as permissionless as possible. And not everything needs to be decentralized, not everything needs to be on-chain. And so it's like, take almost a pragmatic approach towards like, okay, we have this new world, there's this new set of principles, and yes, we want to move towards these, but we have this old world that's kind of stuck in its ways, and there's this inertia that works against you. How can we bridge this world, but not sort of in an idealistic way, but a more sort of practical way? What we strive to do is, you can think of us as like a Web 2.5 company. It sounds like a bad word, but we've sort of managed to stay in CeFi, in crypto, but remain non-custodial, remain permissionless. We don't have KYC, but it doesn't mean that our customers are not KYC, because we rely on the exchanges for that their customers are KYC, but we're non-custodial, we're no cost, things like that, right? And so I think, the devil is in the details, right? Like, and you really have to think about, taking a practical approach. And I think part of our success has really been because we've taken this sort of like, in the middle approach, right? Neither here nor here, but ultimately that sort of gets the space forward.
Yeah. Maybe that's a good segue. I quite like that theme around the principles of a Web 3.0, like risk management, particularly when it comes to also decentralization. To what extent really does it make a difference when you look at onboarding? Is it fully, as you described, you're relying on other third parties and their KYC standards, and you accept that, and how can you prove that? So just wanted to get your take really, maybe Ben, if you want to start in terms of, does it make a difference if you want your risk management, your onboarding view around the level of decentralization you incorporate into this process?
Well, this is the thing. So I really like your comment. Because, of course, first of all, what are we decentralizing, right? We're not really talking about decentralizing the whole world. Like, we don't need to decentralize marriage, for example, right? There's plenty of things we won't decentralize, hopefully. But what he's mentioning, I think this is great, but it's very trade-oriented and very investment-oriented. And I think that comes from a place of, it's the kind of developed world. 15% of the world has access to a lot of the comforts. But again, if we look at any place, Afghanistan, 6% of women maybe has a bank account. There is no access now. It's about risk management, but the whole language around that risk management is different, right?
Yep.
It's how do you hold custody? It's not even around like the trading or any of that. I'm not saying it's, we're a trading platform. But what I'm trying to say actually is that the investment thesis in this whole digital asset space must be on some core principles, including at least a good degree of decentralization. Like if we were to take this and let's say, co-opted by JP Morgan, co-opted by the banks and the institutions, I think the investment thesis is dead. Then it's just trading tokens for the sake of numbers going up and down. And that may be fun. It's not so fun for like some people that may not have so much money in excess to spare, right? So I think I agree with you, of course, in terms of our trading systems and onboarding institutions, they care about liquidity, they care about the matching engine, transparency. But then there's a lot of use cases behind that are, if not more important, in terms of the actual reason of getting into the space. Because it can't just be volatility. Like volatility is attractive for the traders, but volatility is also a sign that we're just not there yet, right?
Yeah, but Kalin, in terms of this point, when you're describing institutional investors coming in, and I quite like your comment, do we then have to sacrifice the principle of decentralization? Do you see that same conflict, or do you think there's a way to bring it all together, particularly what you have been doing in terms of combining both retail and institutional on that platform?
I believe that there is a conflict, and unfortunately, in today's day and age, the way financial markets are structured, this conflict will persist. While decentralization brings a lot of innovation, and makes things more frictionless. It's not a panacea. It cannot solve all problems. In Anand's case, this is very clear. There is, basically a decentralized facilitation of, centralized institutions, meeting in a marketplace where they can execute more seamlessly. But as he pointed out, there's always, some sort of let's say fully compartmentalized processes at the end for KYC, AML, source of funds, and everything, compliance related regulatory issues. B2C, centralized, I think, at least, from where we come from is, has a long, long way to go, because, first of all, this, speaking again from a perspective of a centralized platform, and in our dealings with the institutions, which is a topic of today's conversation, institutions want to make sure that they know who they're talking to. They know, who's behind this platform. They of course, need to be very comfortable with who manages the business, who are the UBOs of the business. In DeFi, this is, largely missing. One big question, that has emerged, over the last 6 to 12 months, I would even say probably even more, 18 months, is that institutions want to make sure that there isn't any chance that their money will be commingled with dirty money. You cannot guarantee this on a DeFi platform. So, and then there's also all kinds of operational issues, when it comes to payments, settlements, fraud prevention, chargebacks, things like that. Again, I love the DeFi model. It is great, in a frictionless world. And it creates a lot of opportunities, but I believe, that these opportunities for the time being will remain on a small scale, because all the requirements, that institutions and even, family offices, high net worth individuals, even retail customers, we have a ton of inquiries, every year from people saying, please help me with my tax return. How do you get that from a DeFi platform? So yes, there is, I think, that for the purposes of scaling our businesses, continuing to grow, at the moment, our user base of 6 million people in over 200 jurisdictions, CFI is the way to go for us.
Excellent.
I think just a quick sort of add, I think from a product perspective, I think, we look at it as there's the customer, like who are you serving and what is the size of the opportunity, right? And, if your customer cares about decentralization, then yes, you should be decentralized, right? Like, who are you serving? I think that's the most important question. People, projects, protocols, companies kind of tend to forget that from time to time. And so, frankly, we think the people we serve, they don't care about decentralization, right? But they do care about non-custodial. So if you think about the principles of Web3, there's non-custodial, there's permissionless, there's decentralization. And if you're making that trade-off as like, okay, yes, these principles are great. We want to aspire towards these, but if I implement them, will my customer care? And in my pursuit of serving, I guess meeting this opportunity or serving or trying to capture this opportunity, and when we find that people don't really care about decentralization. They care about the customer experience. That how easy do you make it for them to consume whatever it is that you're offering to them, right? I used to think it mattered a lot, but now as we're, more and more we're serving people, nobody ever asks us on a client call, like, are you decentralized or not? They will ask you, what are you, like, are you non-custodial, right? And things like that. And they ask you about permissionlessness, not in the within the context of like Web3, but more like how easy is my onboarding, right? Do I need to do extra KYC? Because they don't care about necessarily about like giving you the information, but they care about the hurdle of going through that process, because KYC is like onerous for institutions. You got to give UBO information. It takes time, and people want the product or service immediately, right? So immediacy matters, and so it's a little bit of a nuanced view, but I think generally speaking, it's always a trade-off. But ultimately, it's about the customer. Like, do they care or do they not care?
Yeah. But it's quite interesting because, we work for State Street, which is like a 200-year-old bank, coming very, very much from a centralized marketplace. And I've become more and more over the years like an advocate of this level of decentralization, because it's different to if you want a traditional world. And really based on the expectation that there are technology solutions that can facilitate this. And maybe you can look at this, what your experience is in terms of what kind of technology investments that you have to make in order to facilitate onboarding and comply, because I can imagine in a way there's also a lot of innovation that helps you to generate, if you want, the scale and thoroughness in that terms of research. I don't know who wants to start, but really from your experience, what are the core technology aspects to have a successful onboarding process in the market you operate in?
Well, I mean, I can say a few words here, because this is a process that we have been going through for the last 3+ years in our interaction with institutions based on our previous, proven success with retail. One of the keys of the key differences, between, let's say, the blockchain space and TradFi is that all of us, here and all of our companies are driven towards innovation. So we are much quicker to adopt technology and to use it in our work, to make it more efficient for us on the operating level, but of course, make it much more engaging and effective when it comes to our interaction with our clients. So I think that this is definitely a winning competitive edge here in the crypto space. Of course, anywhere where you can add technology to eliminate a human involvement and eliminate the friction and problems that arise from that, it's something that we have done from day one. So these same type of best practices we translated very quickly on the institutional front when we started our rapid development there. So things like going through the onboarding process, the KYC, the AML in a fully automated way. The institutions onboard the documents. They are automatically verified. We have third-party service providers that help us, with doing the background verifications. So that you can get a much quicker verification as opposed to employing let's say, I don't know, let's say 12, 15, 50 people, that are manually, going through documents. This is obviously immediately one improvement. But as I mentioned earlier, one of the important aspects for institutions is to make sure that the partnering institution meets their risk management standards. So, things related to the origin of funds. We have systems integrated again into the normal operating flow that verify that funds coming to our platform are clean. They're not tainted. They haven't gone through some sort of mixers or aren't related to wallets flagged for hacked funds or laundered money or anything like that. We have additional systems, that automatically provide geo-blocking for certain markets and jurisdictions around the world. And unfortunately, due to political reasons, we stop at a very early stage of assessing whether this is a viable customer that meets our standards. Unfortunately, with certain jurisdictions, they're excluded, from our platform, merely for, being part of the OFAC list, let's say. So anything, where, we can manage risk, and meet the institutional expectations on the same level without making any compromise as part of our daily operations.
Yeah.
So I think it's maybe a good point that we have to keep distinguishing between the assets, whereas let's say the protocols and the platforms where people might want to kind of engage with them, right? So I can understand this rationale completely. We do the same. Like we don't serve Afghanistan, not because I don't want to. It's just, it's very difficult for a centralized platform to get around certain global sanctions lists and these types of, they're almost hard-coded at the moment. But when we talk about the space, I think, okay, this is one conversation, right? How do we serve as a platform where there are definitely benefits to centralized kind of services? But let's look at a protocol and let's just go to the base and just look at Bitcoin and just within that protocol, we can see the transparency and we can see the kind of the decentralized features that make for a healthy, you could say a healthy basis to build on. And we should distinguish that because I would say the assets, especially the assets and the protocols need to be quite robust to have a long-term, whatever happens to the centralized platforms, we can evolve, we can change quickly. That's the thing. We're quite agile. We can move from jurisdiction to jurisdiction. But let's say something like Bitcoin should not have an opinion on the Venezuelan versus the US versus the Cuban versus the Afghan. It can't. And otherwise, that's like, no. These assets are like oxygen if they're proper. They should be nurturing, they should be empowering, and they're for everybody. I think that's very important. And luckily, they're permissionless, so if they can't get it with you, they can get it elsewhere, or in DeFi, or somewhere else. And I think that is quite important as a principle.
Maybe just a follow-up question. This is something that I'm sort of obsessed with these days. If your thesis is, and I think I've heard this from everyone on the panel, that we do see more institutional money come into the space, and they are, in a way, subject to higher levels of KYC standards because they are regulated themselves. Doesn't that then over time also impact, if you want, the protocol, not at a code level, but if all the users effectively bind themselves to operating principles that no longer are in the blockchain protocol, but are now imposed on them externally. Is it still the same decentralized network, even, but
We've seen this happen. Maybe it was 2 years ago when there was this push for I think it was Bitcoin transactions. I think Marathon was kind of getting on the idea like, okay, maybe we just we distinguish between like green, like properly mined Bitcoin and those that were like used with burning coal and stuff. But I think the community pretty much shut that down. I think that's very good. And we'll see now with Ethereum. There's some questions around reversible tokens. I'm not a fan, but I'm maybe a principalist. But I don't know how you think in this. I hope we're not moving towards that. We don't have to mimic what's already existing. We don't have to do that because that didn't work.
Yeah, exactly.
I think that's why it's super important for the community to start pushing self-regulation or self-policing. There seems to be two camps: the regulated camp, and then unregulated sort of Wild West. And I think community can do a lot more to say, like, look, we have this under control. We're doing things to sort of regulate out the bad actors, and everybody agrees. Child pornography, terrorism, all these things are bad, right? Nobody's going to say these things are good. So I think if we start, the community needs to do more. This is one thing I really believe in. And because if we don't do that, then the hand of regulation is going to come down really hard, and then we're going to have to live with this thing that nobody really wants to live with. So we're definitely pushing for that. I think you have to be willing to engage with the regulators, where they're willing to engage, where there is some reciprocity, and push for things and really be sort of ambassadors for change. I think in Singapore, that's one thing we see a lot. It's one of the reasons we moved here. Is just the community here, the regulators. It's a conversation of equals. They want to know, what they can do to make this better, what they can do to make this safer. And if you're there and you're saying, hey, this is how we think we would do it, I think ultimately, debate, and discussion leads to better policy, right? And so, yes, because if we don't, then the future that you're talking about might be materialized, and nobody wants to live in that future.
Sven, I really enjoyed that you asked this question because this is an integral part of our internal conversations on a very regular basis. And this is that, when I have conversations with colleagues in the space here, sometimes it looks like, we try to imagine that there is a fine line, between, both parts. But in our experience, our position is that there isn't. There is a very, very firm boundary between whether you want to operate under the radar, cut corners, basically try to be as flexible with your customers, so that you desperately, need to attract them on your platform and build your business. On the other hand, Nexo, for us, it has been really easy, really easy because, we have made this decision on day one. And we have never made any compromises. I made it a comment earlier that in addition to our leadership role in the blockchain space, we are currently very quickly advancing in traditional commercial banking around the world. We're working with the traditional financial markets by bringing over asset management and wealth management. So there's plenty of conversations we're having along the way with regulators, with institutions, such as State Street, obviously. And for us, the decision is quite easy. It is more difficult for us right now. I mean, again, we have 6 million customers. We could have easily had 10 million, if we made these compromises. But to us, it's a very simple answer. It's not worth it, because, we want to go on a simple path, that, makes us a responsible and dedicated partners to these institutions. They know that with us, there is no chance, that we will not fulfill our, fiduciary duty, our, compliance requirements. No dirty money, no questionable customers. This is the only way. I've always said that the quicker the blockchain space starts looking and feeling more like Wall Street, the faster and the greater the adoption, and I'm, again, everybody's, can have their own opinion, but I think, that all these, things and proclamations, we had back in 2016, 2017, even 2018, how, this is going to be our own, merry community of marauders and pirates, and, we're going to build, this humongous, asset, class and market segment, where we will operate, doing whatever we feel we need to be doing, self-regulating ourselves, but yes, at the same time, integrate it into traditional financial markets. I've always said it's never going to happen, So, there's, practices, principles, policies, systems, that have governed the traditional financial world for, hundreds of years. The quicker we adopt them, but maybe just with the twist of adding technology and improving processes and optimizing where we can, the quicker we will see Bitcoin getting back to 70,000, 100,000 and beyond. But otherwise we have no chance.
Yeah, thank you. Unfortunately, we ran out of time, but I thought it was an interesting conversation, particularly from the perspective like how much probably the TradFi and the DeFi space have to learn from each other. So thank you. Also, thank you for the panelists, and enjoy the rest of your day. Thank you.
Thank you.